There are 6 IRS rules. The people who manage the tax system will never sit you down and explain. And most of you with over $100,000 in savings are making quiet, costly mistakes because of them year after year for the rest of your lives. Here is what I am going to walk you through today. Rule number 1, the savings threshold that puts your retirement account on the IRS radar in 2026 and why the number is lower than most people think. Rule number 2, the required minimum distribution trap that is sending retirees unexpected tax bills this year, and the one move that changes the math entirely. Rule number 3, the Social Security taxation trigger that kicks in the moment your savings income crosses a line most people do not know exists. Rule number 4, the inherited IRA time bomb that is quietly ticking inside millions of American families right now, and the 10-year deadline that the IRS will not remind you about. Rule number 5, the Medicare surcharge that your savings account balance can trigger without a single change to your income, and the appeal process almost nobody uses. And rule number 6, the one that I have been building toward this entire video, the tax move that people with over $100,000 in savings can make right now in 2026 that could save tens of thousands of dollars over the rest of their retirement. And the window to make it is not staying open forever. Stay with me to the end, because that 6th rule alone could be worth tens of thousands of dollars to the right person watching this right now. And let me be clear about one thing right now, because most people assume none of this applies to them. It does. Whether your savings are in a traditional IRA, a 401k, a savings account at your local bank, or a combination of all three. Whether you are retired and drawing down your accounts or still working and letting them grow. Whether you have $100,000 saved or $500,000 saved. And whether you have always handled your own taxes or relied on someone else to do them for you. There is a rule on this list that is pointed directly at your situation in 2026. The IRS does not send a personal warning. It does not call ahead. It simply applies the rules. And the people who get hit hardest are always the ones who did not know the rules existed. Now, these are real IRS rules and real 2026 tax code provisions sourced from irs.gov. The exact impact on your tax situation depends on your income, your account types, and your individual filing status. This is not financial advice, so verify your own numbers with a qualified tax professional before you act on anything in this video. Rule number 1. The savings threshold that puts your retirement account on the IRS radar, and why the number is lower than most people expect. Here is the rule in one sentence. The IRS requires financial institutions to report account activity and certain balances to the federal government, and in 2026, enhanced reporting requirements mean that retirees with significant savings in certain account types are facing a level of IRS visibility that simply did not exist 5 years ago. Now let me put that in plain language. If you have over $100,000 in a traditional IRA, a 401k, or a similar tax-deferred retirement account, the IRS already knows it is there. Your financial institution files Form 5498 with the IRS every single year. That form reports your account balance, your contributions, and your required minimum distribution amount if one applies to you. The IRS cross-references that information against your tax return. If the numbers do not line up, if you took a distribution and did not report it, if you took the wrong RMD amount, if you rolled money over and the paperwork was mishandled, that discrepancy is flagged. Think about who that affects. Think about the retired engineer who has been managing his own IRA for 20 years. He knows the basics. He takes his distribution every year, but in 2025, he made a partial rollover from his old 401k into his IRA and assumed his financial advisor handled the reporting. The advisor handled the rollover. But the 60-day window for certain rollover transactions was missed by 4 days. The IRS now views that transaction not as a rollover, but as a taxable distribution. He owes income tax on the full amount, plus a possible penalty. Now here is the part that almost nobody understands, so listen closely. The IRS matching system does not make phone calls before it sends notices. It does not give you a chance to explain. It compares Form 5498 against your Form 1040, identifies the mismatch, and generates a notice. CP2000 is one of the most common. that arrives in your mailbox with a bill, including interest that has already started accruing. The mistake most people make is assuming that because they have always filed their taxes correctly, they are invisible to the IRS. Nobody with over $100,000 in a tax-deferred account is invisible to the IRS. The question is whether your paperwork tells the same story their paperwork tells. If it does not, you will hear about it, and the hearing will come with a dollar amount attached. And that leads me straight into rule number 2, because it is the one that is generating the most unexpected tax bills for retirees in 2026. Rule number 2, the required minimum distribution trap, and the one move that changes the math entirely. Here is the rule. If you were born before 1951, you are currently required to take a minimum distribution from your traditional IRA or 401k every single year. The amount is calculated by dividing your account balance by a life expectancy factor published by the IRS. And in 2026, those life expectancy tables, which were last updated in 2022, are being applied alongside rising account balances from recent market performance. For many retirees, the RMD amount they owe this year is higher than it has ever been. Think about who that affects. Think about the 76-year-old woman who has been careful with her money her entire life. Her IRA grew well over the last few years. She turned 75 in 2025. Her RMD this year is calculated on a balance that is larger than last year's balance by a meaningful amount because the market has been good to her. She is being required to take out more money than she needs. That money is added to her taxable income, and depending on her other income sources, it could push her into a higher tax bracket, increase the percentage of her Social Security that is taxed, and trigger a Medicare surcharge, all in the same year. Now here is the catch nobody tells you. The RMD is not optional. The IRS penalty for failing to take the correct RMD is 25% of the amount you should have withdrawn but did not. That is one of the steepest penalties in the entire tax code. If your RMD was $15,000 and you forgot to take it, you owe $3,750 to the IRS before the income tax on the $15,000 itself. But here is the move that changes the math. It is called a qualified charitable distribution, or QCD. If you are age 70 and a half or older, you can direct up to $105,000 per year in 2026 directly from your IRA to a qualifying charity. That amount counts toward your RMD, but it is never included in your taxable income. It goes from your IRA to the charity without ever touching your hands or your tax return. For a retiree in the 22% tax bracket with a $15,000 RMD, doing a QCD instead of a standard distribution saves over $3,300 in federal income tax. For the rest of your life, every single year, if you are giving to charity anyway, the QCD is almost always the smarter move, and almost nobody uses it. They do not exactly put it on the front page of the IRS website, and that leads me into rule number 3. Because the savings income from that same IRA could be quietly triggering a Social Security tax that most people have no idea applies to them. Rule number 3, the Social Security taxation trigger, and the income line most retirees cross without realizing it. Here is the rule. Up to 85% of your Social Security benefit can be subject to federal income tax, and the income threshold that triggers this taxation is so low that it has not been adjusted for inflation since 1984. Let me say that again. The income threshold that determines how much of your Social Security gets taxed has not been updated in over 40 years, which means that in 1984, this rule affected a small group of high earners. In 2026, it affects the majority of Social Security recipients who have any savings at all. Here is how it works. The IRS uses something called combined income to determine your Social Security tax exposure. Combined income is your adjusted gross income plus any non-taxable interest plus 50% of your Social Security benefit. If that combined number exceeds $25,000 for a single filer or $32,000 for a married couple filing jointly, up to 50% of your Social Security becomes taxable. If it exceeds $34,000 single or $44,000 for a couple, up to 85% of your Social Security becomes taxable. Think about who crosses those lines. Think about the retired couple who each receive $1,800 per month in Social Security, $3,600 combined, and take a modest IRA distribution of $20,000 per year to supplement their income. Their combined income, as the IRS calculates it, is likely above the 85% threshold. They are paying income tax on the majority of the Social Security they receive, every year, for the rest of their lives. Now here is the part that shocks people the most. The interest from a savings account, even a high-yield savings account you set up simply to keep your emergency fund safe, counts as income in this calculation. The dividends from an investment account count. The interest from Treasury bonds counts. Every passive income stream from your savings gets added to that combined income number, and every dollar that pushes you above the threshold costs you more of your Social Security and taxes. The mistake most people make is managing their IRA distributions and their savings withdrawals as if they exist in separate silos. They do not. Every withdrawal, every interest payment, every dividend is part of the same IRS calculation, and if nobody has ever shown you that calculation and told you what it means for your Social Security check, you may be paying far more in taxes on that benefit than the law requires, simply because of how your income is structured, not how much of it there is. And that brings me into rule number 4, the one that is a ticking clock for millions of Americans who inherited a retirement account in the last several years. Rule number 4. The inherited IRA time bomb, and the 10-year deadline the IRS will not remind you about. Here is the rule. Under the Secure Act, most non-spouse beneficiaries who inherited an IRA after January 1st, 2020 are required to fully withdraw the entire account within 10 years of the original owner's death. There are no required minimum distributions spread out over a lifetime. The entire balance must be distributed within the 10-year window, and every dollar that comes out is taxable income in the year it is withdrawn. Think about who that affects. Think about the 64-year-old woman whose mother passed away in 2021 and left her a traditional IRA worth $140,000. At the time, a financial institution told her there was no rush. The money could sit and grow. Nobody mentioned the 10-year rule clearly. Nobody walked her through the tax consequences of taking all $140,000 out in 1 or 2 years versus spreading it over the full 10-year window. It is now 2026. She has 5 years left on her clock, and if she waits and takes the full amount in years 9 and 10, she could be looking at a tax bill in those years that pushes her into a bracket she has never been in before. Now here is the part that almost nobody understands. The IRS issued guidance in 2022 and clarified in 2023 that in many cases, annual distributions are required during the 10-year period, not just a lump sum at year 10. The rules around this are complex and depend on whether the original owner had already begun taking their own RMDs. But the core point is this. If you inherited an IRA after January 1st, 2020, and you have not had a detailed conversation with a tax professional about your distribution strategy, there is a real chance you are either taking too little, setting yourself up for a massive tax hit at the end of the window, or taking too much in the wrong years and paying more in taxes than necessary. The mistake most people make is treating an inherited IRA like a savings account. It is not. It is a tax-deferred account with a mandatory liquidation schedule attached to it. Every year that passes without a distribution strategy is a year that reduces your flexibility and potentially increases your tax burden. And the IRS does not send annual reminders counting down your 10-year clock. And that leads me into rule number 5, a hidden charge tied directly to your savings that is being applied to Medicare premiums right now without most people knowing they can fight it. Rule number 5, the Medicare surcharge your savings can trigger, and the appeal almost nobody files. Here is the rule. Medicare. Part B and Part D premiums are not the same for everyone. High-income retirees pay more, a lot more. And the income the government uses to determine whether you qualify as high income is not your income from this year, it is your income from 2 years ago. This is called IRMAA, the Income-Related Monthly Adjustment Amount. And in 2026, the IRMAA surcharge thresholds are applied based on your 2024 tax return. If your income in 2024 including IRA distributions, capital gains, interest, Social Security, and any other taxable income, exceeded $88,000 as a single filer or $176,000 as a married couple filing jointly, you are paying more for Medicare right now than your neighbor with the same health and the same coverage. Think about the numbers. A single retiree with income just above the first IRMAA threshold pays an additional $69.90 per month for Part B alone in 2026. Over 12 months, that is $839.40 in additional premiums per person, and it can go significantly higher depending on income. The top IRMAA tier adds over $419 per month to the standard Part B premium. Now here is the catch nobody tells you. If your income was unusually high in 2024 because of a one-time event, a large IRA distribution, the sale of a home, a business transaction, and your income in 2026 is substantially lower, you can appeal your IRMAA surcharge. The form is called SSA 44. It is a life-changing event appeal, and if you experienced a reduction in income due to retirement, the loss of a spouse, or reduced work hours, you can request that Medicare use your current income, not your 2024 income, to determine your premium. The mistake most people make is paying the surcharge without question because it arrived on an official Medicare notice and looked like a settled matter. It is not always a settled matter. The appeals process exists. The form exists. It is available on Medicare.gov, and filing it costs nothing except the time it takes to complete a few pages of paperwork. For the rest of your life, every single year that you pay an IRMAA surcharge, you could have appealed as money you handed to the government that the law did not require you to pay. And now. That brings me to rule number 6, the one I have been building toward since the very beginning of this video. Rule number 6, the Roth conversion window, and why 2026 may be the single most important year to act for retirees with over $100,000 in savings. If you only remember one thing from this entire video, remember this. The tax rates that are currently in effect, the rates you are paying right now on your IRA distributions, your Social Security income, and your investment gains, are scheduled to increase significantly. At the end of 2025, the Tax Cuts and Jobs Act provisions that lowered individual income tax rates were set to expire. And while Congress has been working through extensions and modifications, the direction of travel for tax rates in the years ahead is not down, it is up. What that means for a retiree with over $100,000 in a traditional IRA is this: every dollar sitting in that account is going to be taxed when it comes out. The question is not whether it will be taxed. The question is, at what rate? And if you convert some or all of that money to a Roth IRA now, while current rates apply, you pay the tax today and every dollar of future growth comes out tax-free for the rest of your life and for the life of anyone who inherits the account after you. Here is the math in plain terms. Say you have $200,000 in a traditional IRA. You are currently in the 22% federal tax bracket. If you convert $50,000 to a Roth this year, you owe $11,000 in federal tax on that conversion. That is real money. It stings to pay it. But that $50,000 is now in a Roth account. It grows tax-free. You never have to take a required minimum distribution from it. When it comes out, whether you take it at 75 or 85 or your children inherit it, not a single dollar of that growth is taxable. And if tax rates rise, which the current legislative landscape strongly suggests they will, you paid 22% on money that future retirees will pay 25 or 28% on. Now here is the part that almost nobody understands, and this is the part I need you to hear clearly. The Roth conversion is not an all-or-nothing decision. You do not have to convert everything. The most powerful strategy is what tax professionals call bracket filling, calculating how much income you can add this year before you cross into the next tax bracket, and converting exactly that amount. Not a dollar more, not a dollar less. Year after year, in a disciplined, controlled way, you move money from the taxable bucket to the tax-free bucket while staying in the lowest bracket available to you. In 2026, for a married couple filing jointly, the 22% bracket extends to approximately $194,000 of taxable income. If your combined income from Social Security, RMDs, and other sources is $140,000, you have approximately $54,000 of room in the 22% bracket before you hit the 24% rate. Converting up to that room, not beyond it, is a move that could save this couple tens of thousands of dollars in lifetime taxes. Think about who this helps most. Think about the 67-year-old who just retired and has not yet started taking Social Security. His income this year is the lowest it will be for the rest of his life. He has a 3-year window before he starts Social Security at 70, where his taxable income is unusually low. Those 3 years are the single best Roth conversion opportunity he will ever have. And if nobody has told him that, he is watching that window close month by month without ever opening it. The mistake most people make is waiting. They tell themselves they will think about it. They tell themselves the tax bill from a conversion feels too painful to pay right now, but what they are really doing is deferring a smaller tax bill today in exchange for a larger one later, paid at rates they cannot control, in years when their options will be more limited and their flexibility will be lower. The window exists right now. The rates are what they are right now, and the decision to act or not act will follow you for the rest of your life, every single month, in every distribution you take and every tax return you file. So here's the one thing I want you to do today. One thing, free. Takes about 15 minutes and a piece of paper. Go to irs.gov and pull up the current federal income tax brackets for 2026. Write down the bracket you are currently in based on your last tax return. Then write down 3 numbers next to it. First, your estimated Social Security income for this year. Second, your required minimum distribution amount, which you can find on your IRA statement or by asking your financial institution. Third, any other income you expect this year from interest, dividends, pensions, or part-time work. Add those 3 numbers together. Look at how close that total is to the top of your current tax bracket. The space between your total income and the top of your bracket is your Roth conversion room, the amount you could potentially convert this year at your current rate before crossing into a higher one. Write that number down. Keep it somewhere visible, because the day you sit down with that number in hand, the day you can look at it and say, this is how much I could move to tax-free, everything in this video stops being theory, and it starts being your actual money in your actual account, protected from tax rates you cannot predict and laws you cannot control. That is the move. And the information to calculate it is available right now for free at irs.gov. So let me tie the whole thing together, because this is the entire game in 3 sentences. You are very likely paying more in taxes on your retirement savings than the law requires. Through RMDs you have not optimized. Social Security taxation you have not planned around. Medicare surcharges you have not appealed. And money sitting in taxable accounts when it could be in tax-free ones. But the IRS collects what the rules allow them to collect based on how your money is structured, not based on what is best for you. And nobody, not the tax preparer who files your return, not the financial institution that holds your IRA, not a single person at the IRS, is going to restructure your retirement savings to minimize your tax bill. You have to do it yourself. And in 2026, the window to do it at current rates is open right now. Before I let you go, 3 things. Do all 3. They matter. First, tell me in the comments which of these 6 rules you did not know about until right now. And tell me this too. Have you ever done a Roth conversion? Or has anyone ever explained the bracket filling strategy to you before today? I read every comment. And the answers I get from people in this community shape exactly what I cover next. Second, if this is the first time anyone has laid out the IRS rules for retirees in plain language without the jargon, without the sales pitch, and without the runaround, subscribe to this channel, because this is what I do here. Every rule, every deadline, every tax trap that targets people over 60. I bring it here in plain English so you understand it before it costs you. The next video could be about a rule sitting between you and a smaller tax bill right now. Subscribe so it reaches you. And third, send this to one person you care about who is retired or close to it and has savings in a traditional IRA or 401k. A sibling, a parent, a neighbor, a friend from church. You do not need to say anything. Just send it and say, Watch this before tax season, because the odds are very good that someone you know is sitting on a Roth conversion opportunity right now, or paying an IRMAA surcharge they could appeal, or heading toward an inherited IRA deadline they did not know existed, and they will not find out unless someone who watched this video today decides to share it. You now know what the rules are. Share this so someone else gets the same chance. Take care of yourself, and I will see you in the next one.